If you've ever wondered if whole life insurance actually works, we're going to talk about that in today's video. What we're going to look at is a policy that was started several years ago. We're going to look at first, how the policy was set up and what the original plan was. Then second, how has the policy performed? We're going to look at what has actually happened year over year. And then three, how the client plans on using his policy as the years pass. He has a specific interest in borrowing against his cash value for real estate, and we'll look at exactly how he can do that and the impact that it has on the policy. Let's get on into it and have some fun, shall we? So, his policy was started several years ago, back in 2017, and let's go through the design and overall plan first. So the design of the policy. What design means is when you take a whole life insurance policy, or just a life insurance policy, typically what do we think of? We think of, I buy a policy, I pay a premium, and if I die, money gets paid out. That is a traditional whole life insurance policy. However, what many people are not aware of is that you, the policyholder, can actually choose where your money goes. So, with his particular plan, he wanted to fund $130,000 per year for 5 years. That gets how much money into the policy? That's $650,000. He had money in cash that was not doing anything for him from a growth rate standpoint, and he wanted to move it into a whole life insurance policy. He was interested in what he had heard about it. So that was the original plan. But going back to the design piece, this is what I want to talk about. You can choose where the money goes. So of this $130,000 per year, that's 6 figures annually, he's moving into a whole life insurance policy, and he's interested in this piece right here, which everyone that works with our company, this is what we specialize in. It's our core focus. Whole life insurance products set up for maximum cash value and maximum flexibility. So of the $130,000 per year going into the policy, he can choose how much of that goes toward the insurance premium, and then how much goes toward what is referred to as a PUA. It stands for Paid Up Additions Rider. And we're going to look at the original illustration in a second. But what you will find is that we've got the premium at just about the minimum, which you'll see is $13,000. And then everything else is being plowed into PUAs. So you'll see that's approximately another $117,000. Now here's the thing, because what people sometimes think when they see figures like this is $130,000. Do I have to commit to that every single year? Like if that's what I want to fund the policy with, you may be thinking $13,000, maybe not $130,000. Regardless of that dollar amount, if this is you, when you start the policy, you say, this is what I'm interested in. Once you commit to the $130 per year, does that mean that you are locked into it every year? The answer is no. So if you have a design like this, where your premium is only $13,000, that's the minimum commitment. This piece is flexible, this paid up additions rider, which will accelerate the cash value growth. This right here is really the key to accelerating the cash value growth of a policy, the PUA component. So let's look at the original plan. So we're going to look at the illustration that we started with back in 2017. This is with one of the major mutual companies. Here we go. And this gives a nice breakdown as to where his money is going. So firstly, we stated that the plan was what? How much did he want to pay into the policy? $130K per year for 5 years. If you tally that up, it's a total of $650. An easy way to calculate that, if you don't have a calculator, what I like to do is take the 100, 1, 2, 3, 4, 5, there's 100,000, and then 30,000 times 5 is another 150. Add the two together, you've got 650. All right, so if this is you, and you're trying to figure out, is my policy set up properly? Because when we just talked about the plan design, we said that the premium was what? $13,000. Where do you see that? The question I always like to ask is, if I'm you, I would ask, where is my money going? Of the total dollar amount going in, where's it going? And up here is the premium piece. You'll see that line up with the base policy insurance. So there's your underlying premium, just about $13,000. And then we're plowing everything else into our PUA rider. Now with this particular company, this is Mass Mutual, they've got multiple PUA riders. This was a design where the original plan was just to aggressively fund the policy for 5 years. You will see that things have changed a little bit when we look at the actual results, but the original plan was this. So add those two figures together, $130 per year. Now, look at the cash value. First year, $112,000. By year 5, we've broken even, meaning you've paid in $650,000 and you have $650,000. You've got a bit more than that actually. Here's what I want to hit on though. The first year, you paid in $130, you've got $112. What are the drawbacks to whole life insurance when someone's very interested in the cash value? That's it right there. The first year is the worst year. What is not showing up in cash value is the base premium. This takes the biggest bite out of cash value in the first year. This is a traditional whole life insurance policy, so that is not showing up in cash value in the first year and also the second year. There's also a term insurance rider attached to this policy. There's some fees associated with the PUA rider, which is why we see a little bit more than just $13,000 not show up in cash value in the first year. What I want to hit on is this. Year 1, you paid in $130, you got $112. You got less back than the $130 you paid in. How about in year 2? You added $130, but year 1 it was $112. Then in year 2, it's worth $230. Did you get more or less back than the $130 you paid in? Less. If the first year was $100 and you add $130 to that, then you're at $230, but you were at $112. So we lost money again. How about in year 3? Well, at the end of year 2, you're at $230. Then you add $130. If you're earning 0%, the next year would be worth $360. $230 plus $130 is $360, but you're at $367 and change. Meaning now you're getting money back from the insurance company. Your policy is compounding. What's also happening is that base premium with this product, beginning the 3rd year, begins to come back to cash value. In the first 2 years, the premium does not show up in cash value. That's a big reason why we're seeing less than our total payment show up in available cash value. So when people ask, when he asked, what are the drawbacks to this? What's the worst part that people don't like when it comes to whole life insurance? It's always the early years. So the name of the game is how do you minimize that premium as low as you can based on the insurance company limits, whatever company or companies you're considering, push it down and then maximize the cash value. So that's an overview of the original plan. You'll notice after the 5th year, his out-of-pocket payment is 0. What this is to the left, that annual surrender, that's the premium that's still due, but he's not paying it. The policy is paying for itself through dividends and interest. What I'll add about that death benefit, it's important because it gives us this MEC limit down here. So a MEC limit is a taxable line on a life insurance policy. We've got a lot of content around that. What I'll say in short is the death benefit will often set that at the minimum dollar amount possible in order to give us the needed MEC limit. So this individual wanted to pay in $130,000 per year. We wanted the cash value to maintain the same tax status that a life insurance policy has, meaning we can access it tax-free. However, if it becomes that MEC, that modified endowment contract, it would mess it up. So that MEC limit, you saw, was just at $130,000. That death benefit of $275 gave us the MEC limit of $130. If this was $265 or even $2.7, it would not work. It would then trigger a MEC and we would be forced to pay a lesser dollar amount into the policy. So the design and the plan design was set up with a minimum premium that also allows him to adjust his total payment downward in some years if he wanted to. The plan was to fund $130K per year for 5 years, measuring the cash value growth. So we're going to look at what's actually happened here now. And when it comes to measuring the cash value growth, some like to look at it in dollars, some like to look at the percentage. When in doubt, look at both. And then delete the one you don't like, or keep them both, it doesn't matter. So what we're going to look at is what has actually happened. So in 2017, what I'll add here is the dividend rate with the company he selected, MassMutual, was 6.7%. It has gradually come down over the years, and in 2023, the dividend rate is 6% flat. So in measuring the cash value growth, will the actual performance be more, less, or the same value as that original illustration that we just looked at? It'll be less if the dividend interest rate has come down, assuming everything else has remained consistent with respect to him paying the 130 every single year. So let's look at two things here. First, we will look at an Inforce illustration. If you have a whole life insurance policy, or if you are considering one, what you can receive every year, and in my opinion you should receive, is an Inforce illustration which will display what your values look like moving forward based on what you've already paid into the policy and your current cash value and death benefit. So when we look at this guy, he's presently in policy year 6. Year 7 is June of 2023. If I could write, there we go. But here's what I want to hit on. 702 in cash value. And this represents what the total cash value will be at the end of this policy year. So when you're looking at an illustration and we see these columns, quick side note, always take note whenever you see terms like this, beginning of year or end of year. Very beneficial to have awareness on this. For example, look at this column, annual dividend beginning of year. This means whatever that dividend is, he's going to see that at the beginning of each year applied to his policy. Some companies, like Guardian, when you look at their illustration, will read end of year, and the dividend is applied at the end of each policy year. So it's beneficial to have awareness on that. But when we see end of year, it doesn't mean December of every year. It means your policy anniversary date, which is beneficial to be aware of. So at the end of this year, which is about a month from the date of shooting this video, we're in May, this will be in June, projected cash value, $702,000. Death benefit is still at $2.75 million. Okay, what about all the prior years? 1 through 5. Where's all that? You won't see that on an Inforce illustration. It is unfortunate, and I wish it was there. However, it does not. So what we like to do, and we do this for our clients, is put together historical illustrations which take the values that you actually received, meaning what did I get in my policy, and you can find this on your annual statements that the insurance company will send you every year. You can also find it on your online account. You can often download those annual statements. But what we do is take those values, look at the payments we actually made, and then call it a live illustration here. So in 2017, he was 45 when he started. At the end of the first year, if you go back to the illustration, you'll see age at end of year. At the end of the first year, he's 46. That was in 2017. That's not on the illustration. There's the base premium. Here was his annual outlay. I like the term here, annual funding, and total funding will tally up the total payments over time. So as we look at this guy, here we go, cash value and death benefit. When's the break even? Year 5, meaning you've paid in $650 and you have $657 in cash value. Do you remember what that original illustration was? $668,000. So it's less now on the illustration compared to what was originally illustrated. Why so much less? We hit on it earlier. So measuring the cash value growth, that's what we're doing right now, and this will answer the question. That original illustration assumed the current dividend rate for 2017, which was 6.7%, was applied to the policy forever. This rarely happens. In fact, I've never seen it happen with any life insurance company because dividends change over time. So that 6.7% dividend was illustrated forever. However, things have changed. The next 2 years it was 6.4, then 6.2, then 2 years of 6%, and he's about to begin policy year 7. And then the Inforce illustration assumes the current dividend rate is applied to it forever. So Inforce illustrations are nice to look at, but like the original, the dividend rate is going to change. But here, we've got what actually happened year over year. So there's your break-even point, which is nice. Okay, so moving forward, what do you notice different about this policy compared to the original one? The original plan was to fund it for 5 years. Well, he did that aggressively, but now he looks at it and says, you know what? I can still pay the premium, and I see that when I pay that premium, it does come back to work for me. So I'm going to continue to do it. I don't mind doing it at all. So as we look at this guy, what do we see? Well, the cash value, if I look at year 6, I'm at 702. Pretend this is you. You pay in $13,000. And then your cash value is 748, almost 749. You got your 13 back and a lot more, correct? Yes. However, we're going to measure that growth here, and I want to go through some important pieces. Number one, the dividend rate is 6% flat. Is that what you are actually earning on your policy? Meaning, the growth you saw there is at 6%. You just punch 6% into a calculator. No, it is not. The net growth rate, we've got our annual internal rate of return here, is 4.72%. Meaning, 702 appreciating to 748, call it 749, minus your payment of $13,000. We don't want to include that. We just want to include what we're getting from the insurance company. That's what we want to factor in. Net growth rate comes out to 4.72%. That's the actual growth. Last year, what he actually received in growth, 4.74%. Life insurance policy, non-MEC, where he's got access to it tax-free. I say non-MEC, and I often like to state that it is possible to trigger taxes or run into a taxable situation with a life insurance policy, just so people have transparency there. But looking at this, the IRR will give you your net year-over-year growth rate, and that's the annual. We can look at the average as well, but we're just going to focus on annual for this example. So that's measuring it in terms of a percentage rate. How about dollars? Want to see dollars? I like dollars personally. Now, actually, here's what I want to hit on first, because this is important. What did I receive in dividends? You ever ask that question? If you have a whole life insurance policy, question comes up a lot. And if you have a dividend rate of 6%, what do you think the dividend reflects? Dividend rate is 6%, so the dividend should naturally reflect whatever that dividend rate is. That's what I would think. It's not like that. I wish that it was. The dividend, meaning when you receive your annual statement or look at your online account or an illustration, and we see this right here, this column does not include the guaranteed portion that you receive. It's the surplus only. So, as an example, company's dividend rate, 6%. This is an older product with a guaranteed rate of 4%, which means this dividend column reflects the difference between the two. What the company refers to as a surplus, which is 2% here. So I'll show you exactly what I mean as well. But, well, actually, let's just look at that. All right. So, annual dividends. What he got on his statement, what's underlined, are the first 6 years. What do you notice there? First year, 0, which is typically the case. year 2, 1923. Here's what I prefer to look at. This can confuse people who are very laser focused on the cash value, unless the time has been taken up front to really understand it and the agent went through it with them as well. Because if I see this, that makes me think that's what my policy grew by this year or in year 2. However, when I look at the annual cash value growth, year 1, there's no statement for this, we calculate this, year 1, negative $18,000. What that reflects is the fact that you paid in 130, you've got 111 and change, which is a loss of $18,000 and change. The next year, negative $12,200, meaning that you paid in 130 and you got that back minus $12,200. It's a loss, looking at the overall cash value growth. So the dividend can make it seem like we experienced a gain. Now, one may argue, agent or perhaps one of my peers will say, okay, but in the beginning of year 2, your loss might be $14,000, and then after dividends are applied, you see your cash value go up a bit, and now it's only negative $12,000. That likely is the case, or that is the case. However, looking at just the total payment in, total cash value growth over the course of the year, I do look at it this way and say, okay, well, we did lose money when we look at it. Over the full 12 months, cash value end of year 1, my payment, and then end of year 2, I have a loss. And then moving forward, does the dividend ever equal the total cash value growth? No. Let's look at what happened last year in year 6, because this is what just happened. That's the dividend that was on his statement, $11,115. Here's what the cash value actually grew by, about $32,000. He paid in just his minimum premium. And when we look at the growth, 657 to 702, again, minus the premium, that's what the growth is, about 32K, which comes out to that 4.74% net growth rate. Interesting stuff, right? I love this stuff. But there, measuring the policy in terms of growth, annual cash value growth, we're looking at how much we are getting from the insurance company annually, the net dollar amount they're giving us. Then we've got the total gain on cash value. This one's simple. I can look at year 5. First year, I'm not in the red. Here's what you want to look at, your total funding column. By the 5th year, you've paid in $650. Cash value, $657 and change. The difference is the total gain, that $72.75. All the prior years, you're in the red because you have less in cash value than what your total funding is. See what I mean? All right, so there we go. Measuring the cash value growth is a lot of fun. Now, what he said, this was about a week ago when we connected, was I'd like to use my policy now. Steve, I funded this. We talked about stopping, but I'm going to keep paying the minimum premium because it doesn't hurt me at all and I see it continue to grow. I'm into that. I want to use my policy and I want to use loans instead of a bank. I'm very interested in that because when it comes to policy loans, it's very easy. You request a loan, shows up in your account, no qualification process, nothing like that. We've got other videos that go through the technical aspects of loans, but he's interested in that. He's interested in it for real estate. Now, he's 7 years into his policy. He also asked this question, when does this not make sense? And he's referring to the loan strategy because the numbers we're going to look at make sense. Makes a lot of people look at it and say, why would anyone not do this? I'm going to hit on that point because it's very important to be aware of this. And a lot of times when we're looking at new illustrations or when someone is starting a new policy, they want to begin to use it right away, which I get it, right? Using your money for real estate, business, whatever it might be, like that's where the fun's at, speaking personally. So if I have to put money into a policy and wait 7 years before I use it, like, no, I'm not going to do that. Do you have to wait 7 years? No. Right? You can typically access the cash value a little after 7 days. Does that always make sense? No. But my point is, before I keep on rambling, is when does this not make sense? Let's answer this question first, actually. From a pure number standpoint, a lot of times in the first and second year, or we could just call this the early years, which doesn't mean you cannot access it in the early years, but if we go back to measuring the growth, what happened in the early years when you're paying money into the policy? Was that annual cash value column, was it in the black or was it in the red? It was in the red. You're taking a loss each year. So you've got an effective negative cash value or negative growth in the first 2 years of the policy, and then you're going to borrow against it, which when you borrow against a policy, what do you have? You have loan interest that goes to the insurance company. So if I borrow in the early years, I do have the cost to borrow along with the insurance expenses, so it can hurt me short term. Now, can I make up for that over time? Yes, you can, but where people get angry is when they don't have awareness of that. We just see something like, hey, you can put money into a product and earn this 6% dividend rate and then borrow against it at 5%. That's a 1% spread. It's like, not when you look at the early years. So when does this not make sense from a number standpoint? Typically when the cash value growth is negative and I'm paying loan interest, or if I have a case where I'm paying significantly more in loan interest than what the policy is growing by, that can be something that can be very uncomfortable for people too. The key word here is this: awareness. Have awareness, particularly on the numbers. And if you're not aware because you look at the charts and you say, this is just too confusing, like, I don't want to do it, don't do it until you have transparency there. As an agent being in the business, here's what I'll say: it is our job to help with the understanding. It's very important to work with someone who's patient in any industry, not just life insurance and finance. So, we've got our loan illustration here. A lot of columns. It's not as overwhelming as it looks, I promise. This column right here, LTV, 95% of cash value. He's about to start year 7. Cash value, $748. 95% of that, $711,000. That's what he can access. He's considering, or we've discussed, property of about $500,000. The loan interest rate on his policy has been 5% and still is 5%. It will be 5% for another year. It may change June of 2024, depending on where rates are. 5% of $500,000 is $25,000. Here we go. This is the money question right here. Yearly cash value growth, annual interest payment. What this is displaying is in year 7, the year he's going to be in right now or next month, $33,000 and change. That's what he's getting from the insurance company. We're going to isolate the growth. If he takes a $500,000 loan at 5%, he pays $25,000. Did he earn more or pay more? Earned more. That's what people want to see, including myself, right? If this is my policy. So the 5% is assessed to the loan balance, and then he's earning the 4.2% on the entire cash value. A unique feature to a life insurance policy is when you borrow against it, you continue to receive that compounding on the entire cash value. How the insurance company does that? 1, they do charge interest on the outstanding loan, and 2, they collateralize your death benefit. So look at this guy over here. Death benefit was $275, the $500K loan outstanding. If he dies, the net death benefit is $2.25 million. This does not mimic a direct policy loan with the insurance company, full disclosure. It'll be very, very similar to that, but this is actually meant to mimic a cash value collateral loan, which involves taking a policy to a bank and assigning your cash value as collateral. Let's pay this loan back, and then we will wrap up. Let's pay it back at, we can pay it back however we want. Let's do $50K per year for simplicity. 1 year too many. So $50K per year toward the principal, along with the annual interest payments. And this is what I can look at each year. My yearly cash value growth compared to my annual interest cost. And then I can also look at what was the total gain on my policy and compare that with the total interest paid over time. The fun part about this, it's just like a line of credit. You can always increase your loans and such too. It's all based on that LTV column. Look at that. So we took the maximum loan at 5%. Now all of a sudden, slightly behind the yearly cash value growth. It's beneficial to look at that kind of stuff. So I hope that this video was helpful, just going over the three main items, which is what was the original plan when he started the policy? How has it performed? We measured the cash value growth. And then how does he plan on using it with respect to loans? And then we went through what he's paying in loan interest compared to what the policy is growing by, which is often what people are interested in. We hear about how these products can work, but numbers do provide transparency and answer the question, does it make sense for me? And am I comfortable with what I see when looking at the numbers? Hope you enjoyed this video. Let us know if you did, and we will talk to you soon. I hope this helps.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.